David Weild is the capital markets advisor at Grant Thornton, and David is also the former vice chairman of NASDAQ. Good to have you with us, David.
Nice to see you.
So this change, let's talk about private shareholdings right now, before we get to the IPO and the initial public offering market. What kinds of changes do you think ought to be made to the private share market, which seems to be getting, if not more attention, at least the same amount of attention as the regular public market?
Well, and you raise a great point. The reason why the public market is sort of on the back burner right now is because the SEC's got a lot on its plate. You know, they're going to have a finite budget. Budget wars are going on right now in Congress, and they've had three things that have distracted their attention. One is, or taken a lot of their resources. One is the promulgation of rules under Dodd-Frank. One is the escalation in enforcement activity post-Madoff, and then the third one is the flash crash. So they're really busting at the gills, and so what we've called for has been opening up or creating a new public stock market to support capital formation, but also in a paper that we published back in November of 2009 called A Wake-Up Call for America, we called for liberalization of the private market, which is what the SEC seems to be preferring right now, I think largely because it's going to allow them to take it off of their plate. They just don't have as
So what
big a
kinds of
plate.
changes to private share transactions do you want to see?
Well, there's what I think is an arbitrary and capricious limit on the number of shareholders, which is 499. And if
Once you hit that 500 number, you're considered ripe for SEC attention.
Well, you have to file with the SEC. You're a de facto public company, and you have to register. And so, that creates a lot of inertia in the marketplace because people are concerned about inadvertently tripping it. But they also do end runs around it in the sense that they'll set up a partnership. They'll throw a lot of individual investors, and it'll show up technically as one shareholder, and they'll get around the rule that way. So it's a rule that, frankly, does nothing but kind of hurt capital formation for no good reason. And I think the SEC is right to look at rescinding that. Okay,
so get rid of the rule on the number of private shareholders that are allowed in a corporation.
Right.
What other kinds of things do you want to see happen?
Well, they rescind the prohibition against general solicitation, because what's important is to control who buys it, that they're a qualified investor, an accredited investor, not who actually gets to hear the story. And so to allow them to come on, Pimm Fox on Bloomberg and talk about to get Facebook on television, not have to worry that
you're making the lawyers blanch right now, David.
I mean, it makes it easier.
It may make it easier, but you know very well that in any kind of public company setting, or even in a company that's thinking of going public, the lawyers are very worried about any potential liability.
Right, but I believe in this setting. If the SEC provides a safe harbor, they won't have to worry quite so much, and it'll create a lot of interesting media, if you will. And Americans, frankly, deserve to be able to hear about some of these very interesting companies that are in the private market. But then, in addition to rescinding the prohibition against general solicitation, there are other things that they can do, including taking Rule 144A, which creates an aftermarket safe harbor for qualified institutional investors, or QIBs, qualified institutional buyers, and extend that to the other qualified investors, accredited investors, if you will, individuals in the private market, so that they're not disadvantaged in terms of buying and selling stocks.
In other words, they'd be allowed to go ahead and buy and sell the stock without having to get any kind of dispensation from the SEC.
Right. And right now, people are rationalizing their way to a safe harbor that really isn't a bright line, and the SEC could really help the marketplace by creating a bright line. And then the final thing is to allow people to not simply own these securities with investment intent. That's the word under the current regulations. And it really kind of flies in the face, undermines your ability to make a market. Think about it, because I can't actually buy and sell securities on the day of the offering as a market maker if I have to hold the securities with so-called investment intent. And those four changes, if they were made, would actually give some real gas to this market. It would actually allow many people to put capital formation and job formation and tax creation, tax revenue creation back into business. And in some respects, it would allow the private market in many instances to start to pick up the slack where the public markets have fallen down because of the penny spreads that don't allow Wall Street really to provide the support that's needed for small public companies.
Now, David, when I hear you talking about these changes to rules relating to private companies, I keep running through my mind Facebook, Facebook, Facebook. Yeah. But these changes would not just help, as you described them, not just help big companies like Facebook, but you think they would also help small privately held companies.
Right. I mean, we in our practice, we talk about two types of companies: demand pull, which are the social networking, big visible names, and they don't have to worry about pulling in investors. You can get, they're knocking at the door. That's right. They're knocking down your door. Exactly right. And then there's everybody else, 95+% of the market, which are the supply push companies, where people need to get compensated to create visibility in those names. So if you get rid of the prohibition against general solicitation, it means people can get out there, they can talk without fear of going to jail. It creates a great safe harbor, and that's really going to help, the biotechnology industry, semiconductor capital equipment. I mean, all the things that are really important to the future of the United States.
And that links to your whole issue having to do with jobs, capital formation, building businesses, getting more jobs.
You betcha. And it's the most important thing. I mean, we in our
So where do we stand right now in making these changes happen?
Well, in the SEC, in their letter to Chairman Issa, the House Oversight Committee, basically said, and this was just last week, that they're actually examining relaxation in this particular area, which is something we called for back in November of 2009.
And David, let's switch our attention now from the private market to the public market. This is known as initial public offerings. Yeah. I believe about 40 initial public offerings have taken place in the United States on U.S. exchanges. That's up about 35% from the same period last year. Puts us on a run rate, I'm not going to confuse you with more numbers, about 150 this year. That's not so great, is it?
Well, unfortunately, it's terrible, but on an absolute basis, unfortunately, it's actually a good year in for the last decade. 150 would be a pretty fair year. It's topped out at maybe 200 IPOs. The problem is you go back to the 1990s, and let's not cut out not look at the bubble, but before the bubble. The technology bubble, right before that. We were doing over 500 IPOs a year in this country. And in the decade before that, we were doing about 350. And so as you start to ratchet the level of activity up or the level of activity down, it ratchets up the economy up or the economy down. And so what we've got going on here is because we changed market structure to make it very unattractive and impossible for small companies to get supported, what we've done is effectively we've taken water out of the economic lake and we've shed jobs in this country. And our view is that we lost 10 to 20 million jobs in terms of opportunity costs in the decade of the 2000s because of the unintended consequences of changes to stock market structure. But how do you respond to those that say the dearth of initial public offerings, the fact that we haven't had as many as we had in the 1990s, is merely a reflection of the economic recession that we've gone through, and that there just were not these companies to go public, and indeed there was no appetite on the part of the public for new shares? Well, it's a great question, but we had some great bull market years in the stock market and the economy leading up to the credit crisis. And if you look there, that's when we topped out at about 200 IPOs. And so we never got anywhere remotely close to the 500 IPOs a year that we were doing in 1991, 92, 93, 94, 95, all those pre-dot-com bubble years. So it's pretty clear if you look at it, unless you're in total denial, and there are some regulators that are in denial, unless you're in denial, Pimm, we have done some things that have really shot ourselves in our economic foot as a country. So who has benefited from this? Because it's not as if the world's economic engine has stopped. Right. It's not as if new companies have not come to the public market. Who's been the winner? Well, if you look at it in terms of aggregate listings growth, I mean, China is skyrocketing right now, and actually they've been adding listed companies to their markets, very consistently over the last decade, while the United States has been in secular decline. And I was down in Congress testifying in front of the House Subcommittee on Capital Formation recently, and we put up a chart, which showed this decline. We've had a 42% decline. Think about this. We've lost 42% of publicly listed companies. Those are ones on NASDAQ, the New York Stock Exchange, and Amex since the peak in 1997. Every single year since 1997, we have shed companies from the public markets in the United States. And that my friend, means that we're shedding jobs. We're consolidating through acquisition. We're rationalizing businesses, tossing people out of work, and we don't have the new companies coming into the market, accessing capital, that are out there hiring people. This has just been a catastrophe for the American people.
So the people that get the jobs are overseas because that's where the capital is flowing.
Absolutely, and you know as well as I do that today in this world, a lot of U.S. capital goes all over the globe looking for the best growth ideas. Capital is incredibly mobile. You know,
and it's not just the mainland Chinese market, but it's the Hong Kong market as well, which has benefited, at least according to the data, because there are perhaps, easier ways to go public in Hong Kong? There's more receptive government regulations to new capital formation there?
Well, I think that it's local and it's easier, and I think if you look at a lot of the investors that are driving the growth and the IPO market in Hong Kong, which actually was bigger than the United States this past year, was because it's U.S. investors. It's U.S. and European investors going over to Hong Kong. It's just to the point that you can move capital around anywhere. You're just going to look for the best growth ideas. So that if you don't have a growth economy that's capable of driving, growthy companies, growthy ideas into the public market, then why are you going to invest your capital? And so there are. I don't want to get into names, but there are great American investors that I've talked to, institutional investors that are dyed-in-the-wool growth investors that have actually had to scour the globe and go overseas to find growthier companies.
So what needs to happen in the United States? What regulations need to change in order to encourage initial public offerings to take place here as opposed to in Hong Kong or in Shanghai?
Well, we need to, it's like a 12-step, 12-step program to recovery. The first step is acknowledging that you got a problem, okay? And the problem is, in a penny spread market, you can't support micro-cap names. 50% of all publicly listed companies are $450 million or smaller. They're micro-cap, and nobody can make a living supporting these companies. They've destroyed the economic incentive and killed the whole ecosystem of small Wall Street firms.
We've got to leave it there, but I want to thank you very much, David Weild, former chairman of NASDAQ and also a Grant Thornton advisor on capital markets.